Alright, should be up and running. Let me just double check, make sure everything is good.
Damn.
And I gotta actually make sure that they can actually hear me this time. Bro, I did the whole stream without
You ain't even recording his voice.
yeah, that's what I'm saying. I was like, what's good? Oh, okay, yeah, so we live. Alright, bet. Let me just let me share this again for y'all so y'all can see that.
Make sure your mic on, nigga.
Nah, facts, bro, because I goofed last time, bro. Hold on. Isn't there a way I can, like, pull it up in here? So I can, like, pull up the live stream. Let me see. Your channel.
Hey, Ellis, you still don't smoke, right?
No.
That's a random question.
What's good?
I don't think he's gonna change.
Bro, I have a request for my birthday, bro.
Nah, I ain't smoking with you, gang. I can't, bro.
Pick up that spot.
Yeah.
What about an edible? No? Still no?
Nah, I can't even fold, gang. Gotta stay
You're not
tuned.
going
Alright. I ain't gonna ask no more.
Nah, it's all good. I just want to make sure all this is straight. And then I gotta make sure I can split it so I can see this and this. Alright, bet. And then let's pull back up my chart. Where my chart at? Pull this over here. Alright, y'all can see my screen?
Yeah.
Yeah.
Alright, cool. So let's start off just by going over the homework, because I want to make sure y'all can like understand, and I don't want to leave nobody behind in like their understanding. So I seen Abel put his in there. I'm about to open it up real quick. Put it in the Tonka thing. Let's see. So you went on December 2024. This is the monthly candle, right?
Yeah.
December 2024. Let's find it. December.
Let me hook up one.
Okay, cool. You said you got the high, the low, the open, the close. Okay, yeah. Yeah, that's perfect, bro. Clap it for Abel, man. You did it right. You know what I'm saying? W Abel. Okay. Did anybody else get to do theirs yet?
Yeah, I did mine on paper, but I can't.
Yeah, just take a picture
I
with
was
your
just gonna
phone.
say it.
I was about to say, just take a picture of your take a picture of it on your phone and just send it in that Tonka. What do you call it? The Tonka thing, and you can see it on there.
I bet because I just started typing it on like the actual trading view, and I was gonna screenshot it.
Oh, I mean that's
So
cool
I have
too.
to screenshot. Yeah, I thought that'd be easier.
Yeah, that's cool too.
I'm
Did you
about,
get?
I'm about to hook up my second monitor.
Alright, that's cool. Did you get yours done, Jordan?
I get that shit done.
Alright, bet. So
About
pick.
to right now.
Yeah, I'm about to say pick a candle and then show me the open, the high, the low, and the close, and then let me know the date that you chose. Cause I need to make sure like you guys know how to read this. Cause if you don't know how to read it, then everything else I say after that isn't even gonna matter. Cause you're not gonna know what I'm talking about. What's up,
Hey, but
Manu?
where'd you put it in the chat?
My boy Manu in the cut, bro.
I put it in the Tonka Truck University voice channel, tech channel.
Oh, okay. Bet. Yeah, okay.
Yeah. And then what's up?
All right, but yeah, I'm about it.
All right, cool. Let's see. Let me make sure I get the link for these dudes. All right. So while they're doing that, let's kind of go over what we went over last time real quick. I'm just gonna spark notes it. So last time we kind of went over like the very basics of everything. We went over how to read a chart. We went over how to read a candle, and we also went over why the anatomy of a candle is important. So I know Jordan, you're still looking for yours. Dorian, tell me, what does the x-axis on the graph represent? All right, he might be talking to somebody. Abel, tell me, what does the x-axis on the graph represent?
Time.
All right, bet. And then Jordan, what does the y-axis stand for?
The Y is like the pips, right? Or not like the bread.
Yeah, so the price of the asset. So the reason why that's important is because it kind of helps us read literally what we're looking at. So without time, without price, we literally can't trade at all. Both are just as important, but if I had to rank them in order, price would always be number one, and then time would always be number one, and then price would be second. So let me post this live real quick so other people can join in if they want to. Okay. Did you pick your candles yet?
Who, me?
Yeah.
Yeah, I'm doing it right now.
All right, bet. So just pick one. Just pick one on the screen. So, okay. How about this? I'm just gonna highlight one. All the information that you need is gonna be right here. You see where it says OHLC? That just stands for open, high, low, and close. So I'm gonna hover my mouse over a candle. Let me know what the open, high, and the low and the close of that candle is.
Over the one you on right now?
Yeah.
Oh, the open is what 20,000. The high is 20,005. The high is 20,005. Low. The open is like 20,000 on the top, right?
It's gonna be on the top left. So you see right here where it says open, or it's OHLC. These just stand for like the open, the high, the low, and the close of each candle. So it's basically kind of giving you the answer.
So how are you reading it? Like the open, that's like 20,000, or like how do you like saying that number?
Yeah, it's just price. So it'd be $20,511.50. That's literally all that represents.
All right, bet.
Okay, cool. So that's on there. Dorian, you can still hear me?
Yeah.
Okay, bet. Give me the open, high, low, and the close of this candle right here.
Open is 20,398. The high is 20,996. The close is 20,948, and the low is 20,376.
All right, bet. So now that y'all,
And the time is Monday, May 12th, 2024.
yes, Sirski. So y'all picking up on that. All right, cool. So one of the biggest things that we're gonna go over today, we're gonna go over the major setups, or we're gonna go over the what was I saying? We're gonna go over like the elements to a trade setup, right? So you guys need to understand the basic context of what to look for whenever you're even going for a setup. So my goal at the end of this is for you guys to have a better understanding on how to answer 3 questions by yourselves. So I would write these questions down. Anytime before you do any trade, you have to be able to answer these 3 questions. And if you can't, you should not be trading. So question number 1 is going to be, where is price right now, right? So you need to understand like what you're looking at first. The second thing you guys need to be able to answer is, where did price come from? So by understanding where price came from, it's going to give you an idea of what to expect next, which actually directly leads me to my third question I want you guys to be able to answer, which is, where is price likely to go next? By being able to answer all 3 of these questions is going to give you a very high probability of being consistently profitable. That's why by me showing you guys the context of how to have a, I'm sorry, I'm jumbling over my words. That's why being able to answer these, let me start over. Being able to answer all 3 of these questions is going to give you guys a high probability of making a successful trade and being consistent with it. And by you understanding the foundation or the framework, it's going to give you a solid base to work with going forward when we start incorporating other concepts, because everything just builds off of each other. And once you have a strong understanding of one, it literally goes into everything else. So do you guys have these 3 questions written down right here?
Mm-hmm.
All right, bet. What questions do you guys have so far, if any?
None.
All right, bet. What about everybody else?
I'm good.
All right, cool. So So I'm gonna just leave this up here so we can refer back to it later. All right. So anytime you trade, you're gonna be working off of what we call a market condition. So if you guys had to guess what a market condition even meant, what would you guess? What would you say?
Whether it's bullish or bearish.
Okay, that you're moving in the right direction. Yeah. What about anybody else?
I was gonna say whenever they go about, is it like a consolidating market, or I forget what the other terms are.
Yeah, exactly. So there's only four types of markets that price can be in, right? And we're gonna label it because any type of trade is always gonna stem from one of these four. Let me write this out for you guys. Where's the text? So we're either gonna have there's only four market conditions, and this is super important to write down. So one of them is going to be an expansion. The second one is going to be a retracement. The third one is going to be a reversal. And then the last one is going to be a consolidation. So the reason why these are important is because this is essentially like, if we compare this to a car, this is the framework of the car, right? If you have the framework of the car, you can put all the other mods and accessories all throughout the vehicle. But if you don't have a solid framework, then your car is going to be basura. You know what I'm saying? So I wanted to kind of go over what each market condition actually means and why it's important. And then I also want to go over how you trade in each market condition. Because by understanding that, honestly, this is honestly like the biggest thing that you need outside of like discipline and patience. Because if you understand these four market conditions, you basically know how to day trade. I'm not even gonna lie to you. Let me click on this for you. Fix that typo. Okay. So, what is an expansion in the market, right? So, an expansion is literally just a sharp, high volume price run out of a consolidation zone. So, basically, all that means is like when price starts what people call trending in a certain direction, that's essentially a market expansion. So it'd be easier for me to show you an example on a lower time frame. So this right here, you see how price just kept going up and up and up and up and up and up and up. This right here will be an example of an expansion. So this one price is literally just spooling. It's like sharply running in one direction. That's how you know that price is moving towards a liquidity pool or moving towards its intended target. The second one, which is retracement, is when after price has that sharp expansion, that sharp run going forward, price is going to want to fill in some of the gaps that it left on its way up. So if we're going to find a stronger example, let's see. I want to find something that's easy for your eyes to pick up starting off. Let's see. Might be easier if I go on a lower time frame. Let's find a good one. Okay, here's a version on the downside. So you see how price had this sharp run down, and then price went right back up into this fair value gap, and then it started continuing in this direction. This is all the retracement is. All it is like it gave away its hand in the direction that it wants to go, and then when price comes in to fill in this gap, that's giving you the indication that price is literally repricing itself so that it can continue moving in where it was going initially. The other one that we have is what we call a reversal. So a reversal is literally exactly what it sounds like. After price takes out a liquidity pool or a high or a recent high or a recent low, we can expect price to most likely change its intended direction. By doing that, it's kind of harder not to miss it. So this is a good example right here. So this was an old high. And you see how when price went up above it, how eventually it reversed and it came back down. Do y'all see that? So
Yeah.
So when price bumps these highs and these lows, you can use that as a framework to be able to understand price is most likely going to want to change its intended direction. Me personally, this is probably my bread and butter, just because when you understand the overall direction price is looking to move, you're able to time these sniper entries by using reversal patterns. So a lot of times you're able to find these equal highs or these previous highs or lows, and really use that as a way to be able to time your sniper entry, and you can really maximize the profit on your trades. So there's different ways of doing that. We're going to get into that a little bit later, but I kind of just want to briefly go over what each one, my fault, y'all, what each one means and how to kind of what to expect coming from it. So the next one is going to be the consolidation. This is honestly the start to any single type of trade movement. So the consolidation is always going to be when price is going back and forth within a defined range. So what I mean by that, this is an example of a consolidation, right? So we can see that there's a clear high and there's a clear low that price keeps bouncing between. Am I making sense? This is essentially price when it's moving sideways. So when price starts moving horizontal, here's another version of it right here. You can see how price keeps going back and forth, back and forth. It's not really giving up its hand, moving in one direction at first. And every time price starts to consolidate, we can see that's when the expansion follows. So are you guys starting to see how all of this kind of comes together? It might be easier if I do another, if I make a visual for it. So let's see if I can draw it out. So for example, if it kind of works in like a circle. And what I mean by that is, so you can have your, well, first let me draw it out, because I feel like if I talk while I do this, y'all might not understand me. Put this here.
It makes sense, because that's what one of the dudes I was working with at the hemp shop and shit, he trades crypto a lot.
Mm-hmm.
So like a lot of this stuff is like, it can be used for that too. Like he was telling me how when Bitcoin got to a certain price and it was just that, like the chart, it looked like it wasn't moving for real, it was just going up and down, like same high, new low, like you were talking about. That it was either going to shoot downward or it was going to expand upward.
No, exactly. So all of these are low-key connected. It's like a big circle. These are all just like different points. I'm just drawing like the connections between the two. So if I were to label them, right, everything is going to start off with a consolidation. So when price is consolidating, all that is price building up orders on both sides of the market. So when price is going back and forth, you remember how I said this is an AI algorithm? This is literally that AI algorithm just building up. Look at it like putting Mentos in a Coke bottle, right? So when you do that, you see how the bottle starts to kind of expand a little bit and it's getting all fizzy and tight. And then when you unscrew that bottle, like the liquid just spews right out of it. Pause. You know what I'm saying?
Yeah.
But that's basically the same thing as what price is doing. So look at this as like putting the Mento into the bottle. So it's building up. It's just building up pressure. It's building up pressure. And then all of a sudden it's like, boom, that joint just shoots out, right? So anytime you see price consolidating, in your head, you need to be looking for an expansion soon. And we can see there's so many other different examples of this, right? So price right here was consolidating, going back and forth, then boom, it shot up bullishly, right? Here's another clear one you can see. Price was going back and forth, and then it started trending downwards. See what I'm saying?
Yeah.
Here's another one too. So this is a little bit more of like a harder one to see, but you can kind of understand how it's going. It's still like a clear defined range price is going back and forth in between. So it's going back and forth, and then boom, it springs up. See what I'm saying? So the context of the way that price moves is always going to be the same. Look, consolidating, and then boom, price springs up. Am I making sense?
So we should be getting excited when we see consolidation.
Yes, but in the right context. And what I mean by that is I'm going to show you guys how to pair everything together. But right now I need to break down each tool or each reference point that you guys are going to be identifying. But yes, you're moving in the right direction. When you see consolidation, you need to be telling yourself, okay, boom, I know that price is going to start spooling in one of these directions here pretty soon. So also keep in mind how in the first lesson I talked about the importance of time. If you guys are kind of thinking ahead, you can see why these two concepts are starting to pair with each other, right? So if I'm able to recognize a consolidating market in my head, I can expect price to want to start running within a certain time frame. So now I'm showing y'all what a deer track looks like. Now I'm also pairing it with when that deer is gonna pop his head out. You see what I'm saying?
Yeah.
What about you, Jordan? I want to make sure like this stuff is actually like making sense for you too, bro.
Oh no, you might have to explain that again. I ain't gonna lie.
Nah, you good. You good. That's why we're doing this. Like, I don't want to leave nobody behind, bro. Like, I want to make sure everybody has like a semi decent understanding of what this is. Because even if I need to break it down in a different way, I want to be able to help you guys. Tell me what I said is confusing you so far.
Bro, I got a text, but the last thing I was like locked into was when like you drew the circle and said consolidation.
Is when what?
Like you was drawing the circles and you said consolidation.
Okay, so basically what I was saying is from the last lesson that I was telling you guys about, I was emphasizing the importance of time. So time is the number one aspect that you need to consider before taking any trades. And I was saying how anytime you see consolidation, you need to be able to expect a sharp price run, either bullish or bearish. I'm showing you guys how to pair the two concepts we went over recently so that you guys can start building a profitable trade model. So like I said to Abel and to Dorian into, you know what I'm saying, my nigga Trap Money, I was letting him know. Yeah. I was like, when price starts building up, or I'm sorry, when price starts moving sideways and is going back and forth, like you can, like with your eyes, you can look at this example right here and see there's like an invisible border that price keeps respecting, right? It's just going back and forth, back and forth. It's not really choosing a side of the market. But when price is doing that, you need to start expecting price to move sharply in any given direction, because I use the analogy of putting Mentos in a Coke bottle. You know, when you do that and you see the carbon monoxide, is that what it's called? Carbon dioxide, whatever it is. It starts building up the pressure in the bottle, and then when y'all open up the cap, the Coke just spews everywhere. That's essentially the same thing as what price is doing right here. So anytime you see price moving sideways and it starts going back and forth, that AI algorithm is just building up the pressure from all of these orders that it's about to dump into the market. So understanding that when you see that, you need to start getting kind of excited if you already have a framework set prior to that for you to understand, like, okay, I'm about to get some movement in the market. Am I making sense?
No, yeah, that analogy definitely helped.
Okay, cool. And then, like I said, like this isn't necessarily just a lecture. Like I want this to be interactive. So at any point, if I'm moving too fast or I'm saying something that you guys may not understand, like please let me know, because like I'm not doing this for me. Like I actually want to help you guys, because I feel like if I help y'all, God's willing, this is gonna open up so many other doors for you guys. You know what I'm saying? So like I really want you to not be shy of like asking me questions or nothing. Like you know what I'm saying? We've been boys for like a good minute, so don't feel like I'm like, oh, I want to interrupt them or nothing. Like nah, bro.
This
like
is
you feel me?
not high school.
Type.
Ask no questions. Ain't nobody gonna make fun of you for putting your hand up.
Nah, for real. But
yeah, actually, you know, be good. You know, be a good thing, because I didn't really look at. I know the expansion and consolidation. I know how those look, but if you could, for the retracement and reversal, I don't know if I just wasn't paying attention or if I couldn't see your mouse for one of them. But if you could,
yeah, I haven't
go over them.
Yeah, I haven't got
two,
to yet.
Or, oh, okay.
Yeah. Because you got to keep in mind, I know you probably looked at some stuff earlier before, but I got to treat this as if all of you guys don't know a single thing. So I really want to take my time. I really want to take my time going through this stuff, so like everybody has a good understanding of what I'm going over. You know what I'm saying? So yeah, I'm about to get to that point though. Let me get this set up. Okay. So like I said, everything starts from a consolidation, right? When you start seeing consolidation, you need to be, again, expecting that movement. So after that, you can see how after price consolidates, it goes into an expansion. And we can see here, anytime price is building up, boom, you see that sharp run. Price starts building up, boom, it's that sharp run. Price is building up, boom, it's that sharp run, right? Price was building up, and then that sharp run happened overnight. That's why there's this gap here. But I'm also about to use this for another example I'm going to talk about. So the cool thing is, anytime you have an expansion, that is price tipping its hand. That is, it's aiming for its for this liquidity pool, for a liquidity pool or something like that. And when, like I said, when liquidity pools get hit, what do you guys need to be thinking about? I said it earlier. I just want to see if anybody picked up on it. If you guys were taking notes, you have it written down.
Say what you just said again. What was the question?
When you see a liquidity pool, what should you be thinking about in your head? Price is going to do what?
The reversal.
Yeah,
Okay.
exactly. So just to kind of go back to like what I said, anytime price reverse, or when anytime price takes out a liquidity pool, or which is a previous high or an old low, we can expect price to want to reverse in the opposite direction that the expansion occurred, right? So let's just take this price run right here as an example. So if you're going to map out a previous high or previous low, it's going to be the overall downward movement or the overall upward movement. So for example, this right here is considered what we call an internal high, but this right here will be the external high. So it's exactly what it sounds like. Internal just means within the range, right? So it'd be easier if I map it out so you guys can have the visual. So this right here would be the high. This right here would be the low. And then let me pull up those lines so you can see it. Okay. And then I don't want to expand it. So where is it? Okay, so this right here is what we call a price run or a price range. Literally, a price range is just a high and a low that is clearly defined. So they're not hard to identify. It's literally whatever your eyes directly jump to. So you can see there's a clear like range in certain areas. So like for example, here's another one, right? So this low to this high, you can see how price ran all the way up here and then reverse. When price starts changing directions, that is defined as like a price range, right? So when price took out this previous high, you can see how it consolidated, right? So it's building up the orders, it's building up all the sell orders, and then it expanded and reversed. Am I making sense? So this expansion was also a reversal at the same time. Because again, an expansion is literally just a sharp run in price. So no matter if it's going for a liquidity void or any other type of price action concept, any type of sharp movement is considered an expansion. That is a direction. Now it changing where it came from, that is called a reversal. Okay? So I want to make sure I'm not going too fast. Again, this is the defined range, right? So it's a clear high and low that you can see. It's literally just when price changes direction. So, or when price is, when you see price moving in an overall different direction, that's how you know that, okay, bet, like this is a reversal about to happen. So let me take this off so I can make it a little bit more clear. So this old high right here, this is called buy side liquidity, right? BSL just stands for buy side liquidity. And I also put reversal, right? So which means when price comes above here, I need to start anticipating a reversal, okay? And you can see how that happened.
Okay.
Price had this expansion, or or what we call a liquidity hunt, right? And it took out this previous high. So everybody that was short right here, or anybody that was selling short, they're looking to take them out the market. That's why price does that. When I'm the kind of person, when I understand the why behind something, I grasp the concept a lot easier. So think about it. This market is designed for these banks and these firms to be profitable, not us, right? So the way that they win is when they take our money. And the way that they take our money is by attacking these people who are currently profitable. So for example, if you go, for those who have traded before, let's say I popped a sell right here and price was dropping and dropping and dropping and dropping and dropping. I'm making money. The further it drops, the more money I'm making. But if I'm still in my sell from up here and price begins to come back towards my entry, I'm slowly eroding my profits, right? And then if it goes past my sell entry, now I'm negative. And at this point, this is when people close their entries, right? So when people are like, oh, I closed red, yeah, the bank's got your ass, my nigga. I ain't gonna lie. You know what I'm saying? The bank said, yeah, got that ass, nigga. You feel me? That's basically what they're doing. So that's why you want to be able to understand these areas of manipulation, because when you do, this is what people sometimes call trading with the banks. When you're moving along with these banks, it's kind of like going with the flow. So when you're going with the flow, you're just collecting all the money that the banks are collecting as well. Does that make sense?
Yeah, that's why you say B. Yeah, okay.
Yeah.
That's why it's like when you see these highs and these lows, the banks are targeting them because they understand people there are groups of people that are profitable in these positions. So by taking out these previous highs or these previous lows, like let me find a sell side example, because I don't want to give y'all just one example at all, or just one example to go through. But like I was saying, by price taking out these old highs and these old lows, they're clearing out these orders. Because typically when people put their stop loss, it's going to be right there at the previous high or the previous low. So banks understand the areas to target. And after they target these areas, that's when they start building up the orders to go back into the direction they were going in the first place. So I'm gonna show y'all.
Yeah.
I'm gonna show y'all a buy example, right? So here's one. You see these recent lows? Look how price attacked it. This one is a little bit more violent. So SSL just stands for sell side liquidity, okay? And when you see that, you need to be anticipating a reversal. And you can see price did that, right? So let's say some people bought here. Price went up and sharply took out these lows. So now anybody who was bullish in this area is now negative. And you can see after that happened, price began to consolidate upwards, and eventually it expanded upwards as well. Does that make sense? So it took out the sell side, or it took out everybody who was initially profitable on this short-term run. And then once they took them out right here, price continued going in its intended direction. See what I'm saying? That's why the best ways to trade is to wait for that liquidity either bearishly or bullishly get taken out. Because once that happens, if you already have your context set from the higher time frames, then you understand the overall direction where price wants to go. So this manipulation on the lower time frames isn't going to be tricking you out your spot. If anything, you're gonna be smiling when you see this, because you know you're like, oh yeah, they trying to give me that sniper entry. You know what I'm saying? They trying to hit up brother cash out. You feel me? Stuff like that. So that's why when you see that, you know what I'm saying, you can start pairing everything together. That's why, like, for me, when I started understanding the core of these concepts, this is when trading started to make a lot more sense to me. Now, you're not going to be a master overnight just listening to this stuff. You're going to have to put in that work in your own time to be able to recognize when and where that it happens. But I'm literally pointing you guys directly to the answer. Now it's about you guys being able to identify the answer on your own. So we just went over three of the four. Now the other one is going to be a retracement. A retracement is always going to happen after an expansion, right? So you're not going to get a retracement after a consolidation, just because that's when price is looking to kick off that initial price run. But these retracements come in after price has that sharp price run, and then it just reprices itself back at a lower price. So either people who called the move wrong, it gives them a chance to mitigate or to cut their losses short, or it gives you a chance to re-enter the market if you missed the initial price run. So let me see if I can find you guys a good example. Here's one right here. So let's just use this sell example at this point. So you can see here, make it a little bigger so y'all can see it. As price was coming down, this expansion, right? So this is actually so fire, because literally this is everything in one. Oh, this is so dope for me to show y'all. Oh yeah, let me show y'all this. All right, cool. This is a perfect example. So we're just gonna use this short-term high right here, right? So price came over and bumped this high, or a liquidity sweep, right? So we're gonna say buy side liquidity got taken out. Price then, when it came back down here, you see how it accumulated here, and it also accumulated right here. Like, you see how price wasn't really moving in one direction, it was just moving sideways. So let me highlight that.
Yes.
Let me highlight this. This right here is the consolidation. I want to label this right here. And I want you to see how price literally just repeats itself. So price right here was consolidating, right? And then boom, we have that expansion. So this right here is the expansion. And then, is this moving bullish or bearish? This expansion.
Bearish.
Exactly.
Bearish.
Exactly. So you see how when price did that, then it came back into what we call this fair value gap, right? So let me make this a little bigger so y'all can see it. All right, boom. So anytime we have a retracement, there are two things that you want to target for a retracement, right? It's something that we call a liquidity void, and then there's something that we call a fair value gap, or short for FVG. So let me write this out. This is a good time for me to introduce this to you guys. So anytime you are looking to utilize a retracement, you're going to use one of two things. It's either going to be a fair value gap or FVG, or you're going to do a liquidity void. So there's a difference between a liquidity void and then a liquidity price run or price stops, right? So a liquidity void is literally just when there is absolutely no data. And I showed you there was an example earlier. So it was over that fat gap. This right here, this is a void, right? So if you look up the definition of the word void, it's literally just an empty space, right? So completely empty. That's all that means. So whenever there are completely empty spots, price has a high probability, not every single time, but there is a high probability that price is going to come back into that completely empty space to fill in that data. Because think about it, this is basically like binaries, like 1 and 0s. Like you can't have a data sheet with no data. That don't make sense. So price is gonna come back into that area, and then it's gonna retrace back into that area or backtrack its steps at where it left that open space or that empty void, fill in that data, and then continue in the direction that I was going. Right. So let's go back to it. Where were we? And again, it can be done by having either a fair value gap or a liquidity void. But the liquidity voids they're not always as big as this. Sometimes it's even like the space between the candles. So like you see that little gap between the close of this candle and then the open of the following candle directly after it. That space right in between that's stuff like that has to be filled. So let me mark that up for you guys so you know what I'm talking about. So like this, so like this right here, and then this right here, liquidity void, right? This right here is a void, and you can see how price sharply ran through it, right? Like there has to be data in between these candles. You see how these candles are sitting right next to each other? That's how candles are supposed to form. You can see there was another liquidity void right here, and then price retraced with these candles right here. So look, I'm about to show it. This is how you're able to get like these sniper entries or these very accurate price action deliveries by understanding these type of concepts. So you see this liquidity void between these two candles. Look how price went into it and then wicked away. Went in it, wicked away. Went tapped back into it, wicked away. Went in the exact same thing, wicked away. Price came back one more time and then dumped. You see what I'm saying? So when you understand stuff like that, it's going to help you be more meticulous with your entries and even just like the way you set up stop losses and stuff like that. I'm sure there's another one here somewhere. But I can keep finding more examples.
You just skipped one. You're right. That one, that's a void right there, right?
Yep. Yeah, you're right. This is a void. So you see how when price opened up, right, it came back and retraced up into that. So it's going to want to fill in that void, that empty space. Here's another example, right? So let's pull this out. And you can target these areas as TPs. I do it all the time. So if I see a retracement, boom, look. Bump this high. This is called a what? When you bump a previous high and price reverses, that is called a what sweep. Anybody? Abel. Abel, you tell me.
Can you repeat that?
I said when price bumps a previous high and then it reverses, that's called a what sweep?
A liquidity sweep.
There you go. So when you see that liquidity sweep, right? Oh, okay, price should reverse. But if price reverse, where is it heading, right? You don't have to catch all of this to be profitable, bro. Like, you don't need all of that. just get you the little, you know what I'm saying? This right here. Let's see how many points that would be. So like let's just be modest and say you got in there late, right? You got it from here, you got in down here. That's more than that. So if you would have got in right here, and then price came all the way down here, that's 55 points. That's a lot, bro. Like, especially if you do like a funding challenge or something like that. Even if you just do one, that's probably gonna be like $500-$600. You see what I'm saying? Or even if you do like your own money, you just trade a 0.01, that's $50, bro. That's some people's goal that they set. That's probably 25% of somebody's monthly, what do you call it? Like, you know what I'm saying?
Yeah.
Monthly break even, stuff like that. That's gas money, bro. My car costs like $65 to fill up. That's only $15 coming out of my own pocket if I catch this move right here. And that's just being modest. But let's say you start getting nice, you know what I'm saying? You start getting cold. You're like, oh, okay, bet. Your entry get a little higher, you know what I'm saying? Let's say I just maybe get this candle right here, right? Okay, that's the whole tank right there, my boy. You know what I'm saying? So we ride around for free for another 2 weeks. That's what I'm talking about. You know what I'm saying? So that's why when people start like flexing all these big wins, it's like, bro, them little wins was what get you there, bro. Because when you start catching stuff like this, and then think about it, when your lot sizes get bigger, this same 63 points, it's not gonna be worth $63. You go from a 0.01 to a 0.1. You go from a mini to a micro. Now all of a sudden, that's $635. You know what I'm saying? Don't pop a standard. That's 6 bands. You know what I'm saying? So it's like a lot of time, like this type of stuff got me excited when I first started like learning it, because I was like, dang, bro, like these niggas are really not that nice, not that much nicer than me. They just got more money, bro. Like that's why if you understand these concepts, you can build your way from like a low account to a bigger account. Now, will it take a little bit longer, more patience, more discipline? Yes, but like it's not impossible. You guys saw what I did with 250. You know what I'm saying? And it's literally off of these exact same concepts that I'm showing you guys right now. That's why I really want you guys to like ask me anything that might be confusing, that might not make sense. Because if you guys like understand like the core or the basics, and then you'll understand what to expect next. And if you're able to consistently do that, that's when you start becoming profitable. Your confidence starts growing, your account's gonna start growing too, and then them lot sizes are gonna start doubling as well. Because when you start doing that, that's when them checks really start to hit, bro. And that's when this stuff gets hella fun, bro. I'm not gonna lie. Like, dude, I remember the first time I popped the standard, dude. I caught like 30 points. That shit said 3 bands, bro. My heart was beating. I said, ain't no way, gang. That's a refund check. Oh my gosh. I was like, bro, 3 bands. Like, you know what I'm saying? Like that junk was like, yo, that shit fire. So that's why I'm like,
3 bands before noon.
That's what I'm saying, bro. Like, a nigga used to have to wait a whole semester to see that. Nah, a nigga just made that. And what was this? How long was this? This took 20 minutes, bro. Oh my goodness, bro. 3 bands in 20 minutes. Anybody would take that, bro. You know what I'm saying? Like, you feel me?
Yeah, no,
so that's why like this stuff like gets really exciting for me, because it's like, bro, there's like endless opportunities, man. Like if you really just play your cards right, you can really set yourself up. And you don't even gotta be the nicest. What was that? You don't even gotta be the nicest dude alive. Why is it doing this? What the heck? Oh, there we go. Okay. So we went over expansion, we went over retracement, we went over consolidation, and then we went over reversal. So one of the main things that I want to emphasize, a lot of this stuff starts becoming more valuable when you're able to pair it with your higher time frame analysis. So I want you guys to write something down and to put it in like bold, highlight it, circle it, whatever you need to do, like do that, right? So you guys probably have heard me say this before. I'm gonna put it in all caps. Higher time frames hold more weight. So this is pretty self-explanatory. Benny, tell me what you think this means right here.
Higher time frames hold more weight. We're going to say I want to say like after like a certain time. So like the market opens at 9, then it will be like around 10 or 11. That's when it'll be more like more volume or like more weight, I guess you could say. Like
okay, yeah, so you're starting to point in the right direction. Literally all this means is that your analysis from the higher time frames is going to move. Is going to show you the overall direction that price is going to move on the lower time frame, right? And this is what I mean by that. So let me clear all of this so that it doesn't confuse you guys. Reset it. So for example, let me do something that I did recently. I think it was on a weekly. Okay. So right here, liquidity sweep, right? Sell side liquidity got taken out, and we can see how price did what. Did it continue in this direction or did it reverse? Anybody can answer.
It reversed.
Exactly. So, oops. So this sell side liquidity. Whenever you are on a higher time frame, right? So whenever you are on a time frame that is higher than whatever you're going to execute on, you need to follow that direction. And what I mean by that is, you see how there is. Let me use this example right here. I think this will be a lot easier. Hey Jordan, what is it called when there is an empty space between two candles?
That's consolidation.
Nah, try again.
Oh no, my fault. That's the liquidity void.
Exactly. So you can see how when price reverse, you see how that candle bought all the way through this zone. Price is going to these banks. The algorithm is set to follow these higher time frames because that's what really moves the market, right? They're moving these high volumes of orders, and to do that, they have to target the same type of price action techniques on a higher time frame, right? So when you have more money, you got to move it. When you have $1 billion, you're not looking to move it only 10 pips, right? They want thousands of pips. These niggas are greedy. Like, you got to understand, in the Forex market, it's worth over like $3 or $4 trillion. Not billions, but trillion. So like, these people are trying to run up a Chizek. You know what I'm saying? Like, they're not out here just trying to make 100,000, bro. Like, that's chump change, bro. That's not even their stop loss. You feel me? Like, they're trying to make billions with a B. I feel like sometimes it can be kind of hard to understand like the quantity of billions, but like, you gotta make so many millions just to even get close to $1 billion. You know what I'm saying? So with that in mind, the way for them to do that is to catch these long, elongated moves. And the way that these are determined is from higher time frames, because each candle is going to represent more data, right? More time, more distance that has to be covered, more pips that they are collecting, more points that they are profiting off of. Am I making sense?
Yeah.
Say that one line again. Like what you just said.
So
After talk about the billions.
So the reason why they use these higher time frames to determine these long-term moves is because when there is a greater amount of data that has to get covered, it makes sense for that to be set on these higher time frames, right? So if I'm looking to measure 10 pips, I'm not going to go on the weekly time frame to go do that. I'm going to probably do that on like the 1 minute, right? So banks aren't concerned with these little pushes up right here. Like this little, how many points is this? This ain't even a lot. Yeah, bro, like this 17 points. Banks don't care about that. Like, what they gonna do with 17 points? Like I said, they're moving billions of dollars, and because this is $1 trillion market, they're looking to make these big profit wins, right? These people are greedy. This is how all this stuff is ran. So this stuff is gonna be determined off of the higher time frames. Now, why this is beneficial for us, right? If I understand the overall direction price is looking to go, I'm gonna say it again. If I understand the overall direction price is looking to go, I'm gonna have more confidence when it comes to me doing two things: picking a direction when popping my trade, and also holding my trade for longer, right? Because when I understand the overall move, I can trade with the bank, which means my money is growing with their money. So I'm gonna give you an example, right? We can even just go to like a smaller term example. Let me delete all this. Let me find something that'll be good. Oh, I can use the example from today. Let me pull this up. I think I got that on the 1 hour. So today I caught a buy. I don't know if you guys saw the video that I dropped earlier. I caught a
Yeah.
buy sell. Oh, I'm sorry, not a buy sell. I caught a buy today, but it was based off of my higher time frame analysis, right? This is why whenever you look to take a trade, you want to do something that we call a top down analysis. All that means is that you go from the higher time frame and you work your way down. Because if you do it right, your analysis throughout the time frames will start to correlate with each other. That's how you know that you're on the right side of the market. So if I'm on a higher time frame bullish, I should not be looking for sales when I'm on the 1 minute time frame. That does not make sense unless I'm going to scalp it. But even then, starting off, that is not smart because you're just going to confuse yourself. So let me show y'all what I caught today. I'm going to go over again in case nobody saw it. Here we go. It was this fair value gap. So this imbalance or this area price wanted to retrace. Now I just extend that right so I can show y'all how it came all together. And then these relatively equal highs, right? Or buy side liquidity. So whenever you see relatively equal highs or lows, that's a clear indication that this is going to be a target for price. Now, I always go for low-hanging fruit. There's no need to try to be Superman, right? So if this side of the equal lows is a little bit lower, I'm going to target that. That little 15-point or 20-point difference, it ain't going to make or break nothing I got going on. So it's like, I'm not going, because sometimes price will just bump this high, not clear this one, and then reverse. And now it's like, yo, trade that was green, now red. And I don't want that for y'all. So just go for the low-hanging fruit, right? So understanding I'm on the 1 hour time frame, right? I'm on the 1 hour time frame. So now I understand that. I have an idea of where price is most likely going to go. So if I go back to where price was at 9:30, let's go back to it. Let's go back 9:30. Where you at? Where you at? Right here. And I'm gonna show you how all of this comes together, right? So, let's see, Dorian, what is this marking condition right here? This right here.
Consolidation.
Okay, and then Abel, when price is consolidating, what should we expect?
Expansion.
Yeah, sorry, Ski. You know what I'm saying? Look at the gang working together, man. That shit's so beautiful. All right, let me put in 9:30 candle. All right, so this right here is a 9:30 open or when the market opened. So I want you guys to see something. I'm gonna make it a little bit bigger. Now you're probably thinking, Elias, so price has been going up. Why didn't you look for any sales? I did have a sell. I did have a sell framework. I did have a sell idea framed out, but I'm gonna show you guys how to have confirmation so that you know you're on the right side of the market, or I should say, it's gonna give you a much higher probability that you are on the higher side of the market, right? Because we're humans, we're gonna make mistakes. That's just what happens. Let me go back down to the 5 minute. I went too far. Where is it? Here we go. Try to make this a little bit bigger. Okay, so this recent low, right? Price took it out. Jordan, what is that called? When price takes out a previous high or a previous low and reverses, that's called a what?
Retractment.
A what?
Retractment or tracement.
Try one more time. Pick a different word.
Reversal.
There you go. But it's called a what? Like a reversal is also known as a what? It starts with an L. It starts with an L.
Oh. Oh, liquidity void.
Not a liquidity void, but just liquidity, right? So a void is just when there's an empty space in the data, but this one is just when it took out a previous low. So anytime a previous liquidity pool gets taken out, which is literally just a previous high or a previous low, relatively equal highs, relatively equal lows, that's what we call a liquidity pool. So when price does that and reverses, that's a clear indication price is going to want to reverse, right? So let's go back to the 1 minute. All right, bet. So when price took out this low, price had a market shift right here. I'm gonna tell y'all what that means later, right? I don't want to overload y'all with too much. But when I seen that, I was like, okay, bet. Price is going to most likely start pushing towards this higher time frame, or this stronger what's the right word I'm looking for? This right catalyst, right? This price action, this the price catalyst. I think that's a better word. So understanding that, I knew that I could have held my trade longer, right? So my first TP was just for this liquidity right here, this short term buy side liquidity. This was TP1. Now my long term TP was just the entry of this fair value gap. So I want y'all to see my entry came right here on this candle. So I got in about right here. So I'm just gonna show you how many points that was, right? This is why higher time frames hold more weight. I have more confidence in holding this trade because my higher time frame analysis correlated with where my entry and my overall direction was heading, right? So this was over almost 150 points, right? Let me go back to it. It's right here. Yeah, so I caught about 150 points off this move. You see what I'm saying? This is why the higher time frames hold more weight. So not only did I collect some cheese off of this one right here, but I also have my no limit soldier right here doing numbers. You know what I'm saying? That's why I want y'all to be able to start understanding this stuff, because like I'm not doing nothing special. Like I be trying to tell y'all, this stuff isn't actually as hard as you think. I think learning it is just the hard part, because sometimes people might be intimidated from not understanding what their eyes are perceiving. But once you understand what you're looking at, this stuff becomes a lot easier to read. So think about it. Even if I just did a 1 cent, that right there is just 150 bucks, which is smooth, bro. 150 in 36 minutes without having to go to work. That sounds like a good day. I ain't gonna lie. You know what I'm saying? But
Yeah.
you know what I'm saying? When you up the lot size, that become 1,500. Now that's rent. You know what I'm saying? Nigga just paid his rent in 30 minutes. That's kind of smooth if you ask me. That's, you know what I'm saying? So that's why I'm like, I don't know. I just get excited for y'all dudes, bro, because it's like, bro, like I've seen it work in my life, and I want you guys to be able to make it work too. You know what I'm saying? Am I making sense? Or am I just like rambling?
No, you are. No, for sure. I was gonna say, can you go over the same game plan you just said you did this morning, but like in a faster way? So like it's like smooth. Like how you just say you checked that higher time frame, you went back to like the previous like high from on the, if you go to the left, and then see like the whole analysis again. Like just, I know you broke it down. Like you put the like you said, like you started it off, but I want you like to kind of like redo everything. But you can keep all your marks up if you want it or not. It's up to you.
No, I'm gonna go over it real quick because I gotta meet my mom somewhere in a few minutes.
Okay.
Let me do this for you real quick. Okay, so I'm just gonna recap everything, right? So I said there are 4 market conditions, right? I said that there is a expansion, a retracement, a reversal, and consolidation. Everything starts from the consolidation, right? 9:30 open was right here. This is when the market opened. So I'm gonna put that mark right here for you guys real quick. But beforehand, like I said, you have to ask yourself 3 questions before you pop any trade. Where is price right now? Where did it come from? And where is it most likely going to go? So let's just go through each question. Where is price right now? Okay, right now price is consolidating. So I understand I need to be expecting an expansion, right? Where did price come from? Price came from lower prices, which means we're right now, currently, before this even occurred, we're in a bullish setting, right? So now I have 2 things in my favor. Okay, so where is price most likely going to go? You always want to use the higher time frame. That's where I got that. That's why I got this 1 hour FVG all the way from back here, right? Because I had to see where price was heading to. So this was the most recent price action that it was heading towards next, because all this other stuff had already been cleared out and whatnot. So understanding that, I was like, okay, bet. There's a higher chance of it going up. Not 100%, but there is a higher probability that price is going up. Now I need my confirmation, right? So I said this is when you start incorporating the other 3 things that I was talking about. So when price consolidated, it took out people who had their stop loss right here, right? So this is what we call a liquidity sweep. So anybody who had their SL right here got taken out. No longer, they ain't catch none of that. So this is what we call sell side liquidity. So when price takes out a lower short-term high or an external, when price takes out a internal or external low That's called sell side liquidity. So when that happens, I understand I can start to expect a reversal, right? So you guys are seeing how all this is starting to play out one after another. So we consolidated, we took out a low, or we took out liquidity, and now price reversed, right? So when price reversed, it retraced with this candle back into this order block. So anytime you have an expansion, you want to be able to pair it with an order block. An order block is simply just a set of candles that price used to take out the previous liquidity. What I mean by that, so you see how all of these down close candles were used to take out this low right here? That means in my head, I can understand that this whole price run right here can be used as a trampoline for price to continue in this direction. Think about it like Mario, right? So you know how you jump on that little cube and then he started jumping hella high? It's the same thing. So it's like Mario jumped, he landed on that trampoline and then sprung up. So this little wick right here, it touched right back into this high. That's why I popped my buy right here. So I'm gonna put it right here. Alright, this is a bullish order block. So when price actually did it twice with these two candles. This candle here, and you also could have got in right here. And then that's when it started going up, right? And then look what it did. It consolidated. So when it consolidates, we need to expect a what? Anybody?
Expansion.
Exactly. And
Expansion.
then magically it just started going up. I wonder why. You know what I'm saying? But then again,
Yeah.
you can see on the thing I talked about the macro time frame. So the 950 to 1010, that's that time window that price likes to, with the high probability, start spooling towards the direction that it wants to go. So I understood around that time frame I didn't expect my money to start jumping up. And obviously that's when it did it. And then you see how some of these black candles or these bearish candles, it's just price reversing into these imbalances, or it's retracing into these pockets of data that need to be filled, right? So this liquidity right here, oh no, I'm sorry, not liquidity, this fair value gap right here, boom. See how price retraced inside of it, and then it continued in its initial direction into TP. So if you missed, entry 1, if you missed entry 2, there was a third entry you could have got into, and then you could have just rode it to TP. See what I'm saying?
Yeah.
And then that's it. And then you go about your day, and you stop being greedy, so you don't blow your account. Know what I'm saying? Yeah, that's actually. So yeah, we can call it a day right there. For homework, I want you guys to find me an example of each of the 4 types of market conditions, right? So I want you to find me any example of an expansion, any example of a retracement, any example of a reversal, and then any example of a consolidation. And I'll give you a cheat sheet. If you find a consolidation, you'll most likely find everything else. So you can see, this is like my 3rd example of me showing you. When you see the
fucking cheat sheet, nigga. It's like, no, I'm playing.
Nah, I feel you, right? But I'm just showing you, if you find that consolidation, you're most likely gonna find your liquidity, you're most likely gonna find your expansion, and you're most likely gonna find some sort of retracement within that expansion. So if you just find this, you'll probably find everything else. Make sense?
Yep.
Bet. Well, I'm gonna go hang out with my mom because I'm supposed to meet her to go get some food, and then I'm gonna catch up boys later. All right?
Tell her I said Happy Mother's Day.
Already. And then And then I was gonna say we can pick back up on Thursday, so I'll give y'all a day to kind of start looking this stuff up for yourselves. So let's try to go for like Monday, Tuesday, Thursday, and then like Sunday or something, because I know the weekend niggas be busy.
We can do that.
All right, bet for sure.
Sounds good.
Say less then.
Bet.
Well, all right, bros. I'm gonna hit y'all up later. All right.